Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Alex Luck from Everest Wealth. How you going, man?
Very well, mate. How are you?
Very good, very good. And excited to be back answering questions. We've got a lot of questions streaming in via the link in the show notes, or if you're watching on YouTube below the video, you can hit ask a question and you get someone wonderful like Alex to come on and answer your questions, whether they're financial planning, super, insurance, you name it, you get it. So, mate, we've got a few questions there. We've got questions on HEX. That was very topical last year. We've got car loans, which are always topical. Super, business questions, property questions. We've just got questions left, right, and center. So it's great. But before we get to that, how are you going?
Yeah, not too bad, mate. Busy, helping out a few clients coming through Rask as well. So it's been great to getting to know the community and how we can potentially help them there as well. But all ticking along nicely so far. Yeah.
So for those of you that aren't aware, we've had Alex on the show quite a few times and he'll be back more in the future. You can get in touch with him. You can head to Everest Wealth, or there is a link in your podcast player to get matched with a financial advisor. We've had hundreds of people now do that, and it's been truly wonderful to see. Just as an FYI to anyone that may be new, and even people that are existing, if we do answer questions today and on any day, we can only give general financial advice only because we do not know your needs, goals, or objectives. So if you do want information that is personalized or tailored to you, speak to a financial advisor like, say, Alex here. And if you want to learn more about what Rask can and can't do, you can head to the Financial Services Guide, which is available on our website. A special note, we're going to be talking about super today. We may even talk about things like ETFs and those types of things. They're financial products, that's what we call them. And there is a product disclosure statement, or PDS, that should be available on their websites, which allow you to understand the products better. So go and check those out before you make any moves as well. We are going to speak generally because we have some very general questions. We don't actually know everyone's name when they write into us. We kind of anonymize them if they've given us their name, Alex, because we want to keep it general. The first question is on HEX, whether to HEX or not. Hey guys, and he tells us what his name is, so I'll keep that out. And he goes, hey guys, wanted to ask about HEX debt. I plan on doing a Master's of Teaching after finishing my bachelor's degree. However, after having a look, my HEX debt will be around $110,000, 5 exclamation marks. It got me really worried and was hoping for some advice around it and how worried I should be. Cheers. Alex, you have a lot of clients that have HEX debts, are worried about it, I'm assuming. Some of them probably not as much. But how do you think about this?
Yeah, look, it's a tricky one, and it's definitely a case-by-case scenario when you're looking at these things. But yeah, it's obviously become a bit more topical, the last year or two, because obviously inflation is higher. So HEX, the interest that you effectively pay or gets added to your loan each year is at the CPI rates, which have obviously been much higher than sort of the 2% that we've been used to sort of the previous decade. I think there's a few things to think about here. When you're taking on a degree, just even in general, is looking at the cost of that degree. How much can I then earn from that, right? Because it's effectively an investment in yourself. So if I want to do engineering, the course is going to cost 60 grand. What can I then potentially go on and earn as an engineer is a very easy way of sort of looking at that. So in regards to this question, in terms of teaching, it's probably thinking about what am I potentially going to earn as a teacher going forward? How long, therefore, is like my payback period going to be in regards to HEX? Because the more you earn, the more you will pay back. So don't quote me on this, but I'm pretty sure sort of 55,000 a year, you're not paying anything back, and then it effectively jumps to sort of 8% of the balance, and so on and so forth. There's a few sort of tiers in regards to then how much you effectively have to pay. I don't think it's necessarily anything to be too scared of though as well, because at the end of the day, it is an investment in yourself. You're getting that degree, which then obviously opens the door to that career. I guess specific with teaching, and again, this person should do their own research in terms of what's available out there and stuff like that. But I had a housemate that I lived with a number of years ago, and she had done a previous bachelor's degree and then decided to do her master's. And she actually found this this pathway where she ended up in Darwin for 2 years and effectively was able to teach full time. So she was paid full time and study full time to complete her master's. So that was a really great way of effectively, getting that degree, but also, sort of teaching and getting paid from sort of day dot. So there's things like that out there. I think for specific occupations, obviously there's quite a teaching shortage right now as well. So
Yeah.
there's other ways that you can go to obviously, reduce the impact or supplement that cost if that's, again, sort of an option to you as well.
Yeah, I know that some friends who through our footy club recently completed teaching, and they were working in their final year. There was a real need, as you said, and they were able to work a certain number of days and basically be paid like a emergency teacher. So that was really great because they could effectively get on the job experience and earn a good wage while they're transitioning through study. I always think about this idea of like investing in yourself. I'm glad you phrased it that way. It's really interesting because, like, say, for example, the indexation last year in 2023 was 7.1%. It means if you had a $100,000 HEX bill, it's gone up 7% for no reason other than inflation. Year before, 3.9. Year before that, 0.6. Year before that, 1.8. And it was at that range for about 5 or so years. So over the last 10 years, it's been a lot lower than it was last year in terms of how fast that was going up. A lot of people get a bit outraged on social media because their grandparents or parents got it for free.
Yeah.
And that's fair. That's fair that you'd be upset about that for sure. Relatively speaking, we're worse off. But the way I think about this, and you've raised an interesting point there, was you're investing in yourself and you're getting a career that may pay more and have a payback period. If you think about it, your wage, if you get into a career like teaching, is probably going to go up more than 7% a year on a better salary as well. So you're going to be earning more. Yes, you'll be paying back, but you'll be earning more and it will be growing. That's the idea. So I actually think an investment in yourself is a wonderful thing because if you go forward 20 or 30 years, you might pay your HEX off in 5 to 10 years or whatever the case may be. But in 20 or 30 years, you're earning significantly more because you've got a better career and you're inflating that income as well, which is a wonderful thing. So I've got quite a HEX bill, I'm happy to say, and I'm happy to rack it up because it's the cheapest loan I'll probably ever get. So I'm happy to do that, mate. And that's just the way I think about it. But obviously, everyone's case is different.
Yeah, and I think like a few other just tiny pointers on that as well to consider is having a HEX debt will affect your borrowing capacity in terms of if you're looking to purchase a house. Obviously most people when they're in uni and they're a bit younger, they're probably not looking at that point in time. But if maybe you're reskilling, in your 30s or something like that as an example. So just obviously bear that in mind. And that indexation that we're talking about, so like the interest on the loan is actually not applied until June 1st every year as well. So you can effectively, through sort of a lump sum, pay that into your HEX to reduce that impact as well. And then final point on that too is a lot of the time, if I come to work for you, Owen, and I feel like my form, obviously you can hire me.
You'd be welcome, but we wouldn't be able to afford you. But go on.
Anyway, all right, we won't enjoy too much about that. And I tick on that on my form. I've got HEX. So when you pay me my fortnightly salary, you're keeping that aside for me and passing that on to the ATO. That's actually not applied against my HEX debt until the end of the financial year, but the interest is applied from the start of June, so a month 4. Okay, so
interesting.
Sometimes I talk to clients, they're like, yeah, but so it should be coming down every time that fortnightly pay is taken away. Unfortunately, it's not. So the only way to so where this can be applicable, which is probably a better way because this is probably just confusing people now, is say you've got $5,000 left, right? And you've got $30,000 in the bank and you're like, look, it's just going to be better for me to clear this $5,000 from my borrowing capacity after chatting to my mortgage broker. We go, great, Owen, let's make sure we pay that before the start of June. Otherwise, you're going to have $5,000 plus the CPI interest for this year as well.
So which you can before June.
Yes, pay it before June. Yep.
Okay, that's great. Yeah, you made a good point about borrowing capacity. It's probably the one big downside that I see is people trying to buy a home. We had to clear my partner's HEX debt as well to do that because, like you said, it does come out of your salary. So that's the way you pay it back here in Australia. And that does mean that you have a lower after-tax income. So reduced borrowing capacity effectively. That's a really good point, mate. So not all's lost if you do want to study. I think there are worse things to get a loan for. Pinky with no brain writes in and says, The day I turned 18, I applied for a $15,000 car loan over 7 years at 11% interest. I was earning barely $400 a week, and after 3 years, I sold it for exactly half what I paid, which didn't even cover the outstanding balance. I still consider it to be the worst decision I ever made. What would you say to anyone who is thinking of doing something similar today? Alex?
Don't do it.
I would say the same.
No, I think this is the trap that a lot of people get into. I think when they first become adults. The good thing is this person has obviously learnt from this mistake. I think that's really really important to sort of note down as well. But yeah, it's something that you do see quite common, stereotypically, the first car or the second car, when you get that first pay slip, so now you have some borrowing capacities. Instead of buying that 10 grand car for cash, or 5 grand car for cash, which look, is a bit of an old bomb, but it works and stuff like that. You go out and you get the 25 grand, 30K sort of brand new or near new sort of car, and it goes on a car loan, and the car loan interest is normally somewhere between 7 to 15%, which, as we sort of discussed before, like if you go off investment returns and stuff like that, it's pretty hard to get 15% year on year in sort of standard markets. So rarely does it work out well. Plus, obviously, a car is a depreciating asset, so it goes down in value, which this poor person obviously discovered when they decided to sell it, and still didn't even clear the outstanding balance.
Yeah.
But I guess the final thing on that I can just add is, like, if you need the car for work, right? So back to that previous question before about how I'm going to rack up my HEX to 110, because effectively that's an investment in my education, where it gets me a bit of a job, which increases my earning capacity, et cetera, et cetera. It's somewhat the same with the car. I guess where people, I think, become emotional with it is like, would this car that's 5 grand, which is mechanically okay, going to do the exact same job as the car that's 50 grand? And at the end of the day, they've both got 4 wheels. They should have a steering wheel and a couple of doors, right? And seat belts. So their function is effectively the same. It's just one is, in this example, 10 times more expensive than the other. And that's where I think, look, we're humans at the end of the day, and you go, "Ooh, that one's shiny. Give me that one," as opposed to the one that's not.
We do. We love that sort of a thing. And I think one of my notes that I had here was a lot of people, when they're at this age, I did the same thing. You kind of get hung up in that. You get hung up in like social approval and social pressure to have a nice car, because maybe you didn't have that much money growing up, or whatever the case may be. And you think to yourself, well, this is a way for me to stand out. Like, this is a way for me to, kind of have some worth, or find that kind of thing that I have as a shiny toy. I think it's when you get a little bit older, you realize maybe that's not as much of a focus. And that said, I think that there are a lot of people that have the same problem later on in life as well. You see a lot of people. I often walk out in the street. I'm very blessed in that, both of us are. We get to work in finance. We get to meet some people who are extremely wealthy. And despite all of that, I walk outside and I think to myself, who the bloody hell owns all these cars? Because there's so much money that's gone into paying for these things. I just think to myself, who can afford that? And I just think that, like, every day I walk out there, and I know a lot of it's financed, and I know that's pretty scary for a lot of families. So yeah, I once did the calculations, and I had an old Holden Rodeo, I think it was, back in the day, one of those utes, the 4-wheel drive utes. It's pretty new. And I remember I didn't pay 20 grand. It was just under 20 grand, I think, or maybe about 20. I realized that the cost of that car, if I had owned it for 7 years, which I had it on the loan, was going to be about 65, 70 grand, including servicing, maintenance. A loan, typically the bank wants you fully insured as well, which is so. I just was like, wow. And then I ended up getting a Holden Barina, which was like a little beep beep car. That got me around, because I didn't need that ute, right, as much as I loved it. So I would just say, particularly at this stage of your life, you probably want to spend money on things that are something else in your life. Like, sit back and think,
at any stage of your life, though, I think as well. Like, a common thing we see, like when we're going through clients' cash flows, like, is that car loan. So like they've bought that Range Rover maybe before they came to see us, and it's costing them 15 grand a year or something like that, which, just, no matter how much money you earn, like, unless you're earning like millions of dollars a year, like, it hurts, because as the progressive tax system is in this country, the more you earn, the more tax they take. So like, it's it's hard to get that much further ahead, really, because so the more you earn, they just simply take. So, it sort of keeps everyone in a similar-ish band, to a degree. So, and that car loan, I think almost at any kind of grade,
true.
it hurts their cash flow.
Yeah, but we always, I love that. I love that point about the progressive tax rates, which is often lost on some people. But we often, buy emotionally and justify logically, like, oh, I needed this $75,000 Hilux. I'm a second-year apprentice. I've got to carry my tools.
Did I tell you that? I might have said this story before, but yeah, I had a client the other day, exact same thing. Worked in medical sales and, loved the new car and basically bought the new Ford Raptor and was telling me that he needed that basically because of his job, which involved driving largely around the CBD, which I laughed and I called him out in an e-chuckle and he's like, that's what I tell myself is that I already joked. So,
yeah, but we do it all the time, right?
Yeah.
All kinds of purchases. And there's three things that we covered private schooling recently, but there's three things that get people hung up in life. There's the car or the transportation. There's the house where you live, where you rent, whatever. And then there's your education, which we handled in question number 1. And if you just focus on those three big things in your life and you be creative in the way you manage those, you'll be well ahead of everyone else in life. So, I would avoid a car loan earlier on. If I had my time again, I would have spent that same amount of money and gone to Europe or done something like that for those memory dividends. Question number 3 is from Party Pooper. And it's quite long, so I might love the name, but I might condense the question down a bit. They basically said they discovered the Rask courses and podcasts this year and have learned so much. Thank you for making this info so accessible. Well, you're very welcome, Party Pooper. Here's my question. Can you build an entire ESG/sustainable core portfolio? Would this be a higher risk, higher cost portfolio unsuitable for a beginner? From what I can tell, if you took the ASX 200 and applied environmentally aware negative screenings, the top holdings would be quite different. And they go on to say that they're going to look to invest in the ASX 200 and something in the US, but they're looking for more sustainable, ethical types of investments. Is this a realistic thing? So is it realistic, Alex, to build an entirely ESG/sustainable core portfolio?
I think it's certainly realistic, but it comes back to then like, what's your definition of core? Because, typically investing when we're saying like, that's my core portfolio and then I have some satellites, is the core portfolio part you're sort of referring to generally is like, the ASX 200 as is or the S&P 500 as is. So once you apply ESG filters, as this person has sort of, obviously realized doing it themselves, is a lot of those holdings then potentially sort of fall out. So let's take the ASX as an example. BHP, I think, is number 1 on the index still. So if we're, as part of our ethical views, you and me are like, nah, we're not doing anything to do with mining regardless. So that would then come off, which is then going to quite drastically change, our holding from a stock standard, ASX 200. So you definitely can still build a diversified portfolio, I think, with ESG 100%, but it is understanding that you will be gearing yourself in, slightly different directions and sometimes largely different directions than what the status quo is. So, and if I can then talk to this a little bit longer, it's when you're looking at ESG, and this is what we do, I guess, with our clients when you come to see us, it's like, well, what specifically is important to you within that? Because, being ethical is an ambiguous term for starters. Your ethics are my ethics. I think we get on pretty well, and but at the same time, there would be some point where I'd be, well, I want to zig and you want to zag, right? That's just the way life is. It's interesting. So when you're looking at these products, it's really important to look at the top 10 holdings in terms of what they actually hold and read their charter. So what do they define as ethical investing? Because clients, I often find sometimes shocked when they might come to see us and they've picked in their super fund the ethical option and we're chatting about that. I'm like, well, have you looked at the holdings? And generally the answer is no. And then when we see the holdings, half the time, holding number 3, they're like, well, hang on, FMG, no, I didn't want any mining. That's not ethical. But it might be in that portfolio because FMG has a very large green energy project. So that super fund has deemed, whilst they do dig stuff out of the ground, on the other side, they are working very hard on green technologies, right? So for them, ethical tick as an example. So it really is about, thinking about your own ethics and then trying to apply this. In saying that as well, because I've had a client recently with this who she has very, very strong ethical views. Probably the strongest I've ever seen dealing with anybody, right? In terms of like, she really, really wanted to basically somewhat achieve what this person was saying, like in terms of customizing it. And somewhat unfortunately, she's come to the realization that while she can get it pretty close that she wants across several sort of different products, there's always going to be something in there that she doesn't necessarily agree with, unless she goes for just her own direct shareholding, which we've sort of chatted to her, like from a diversification play and stuff like that. We don't think that's the best idea. So I don't know if that's the question or not, but
No. I think it's a wonderful explanation. I would agree for what it's worth with a lot of those things that you said. I think that if you look at like the beta shares range of products, like say the DZZF ETF, which is the diversified ETF, that's often seen as a pretty out of the box kind of thing, like happy medium for people that have a view around certain industries in investing. We have these industries which we call sin stocks. So basically the things that are in the sin bin, like tobacco, pornography, alcohol, gambling. Everyone has their own views on those things, but for the most part, they're called sin stocks. We just apply a label. And a lot of these ETFs, you mentioned they're filtering. So for people's benefit that aren't aware, there's basically two ways to filter stocks or bonds or anything in a portfolio. So like an ETF is created and it says, we're going to exclude things from tobacco, say, for example, because most people, in our opinion, don't see that as ethical. Okay, so that's excluded. That's called a negative filter. It's a negative way to get things out. But you can also have positive filters, and some of the beta shares ETFs do this. There's many, by the way, like Vanguard has them, Russell, etc. But on the other end, you can have positive filters, which bring something in. So it might be like, we have this portfolio that's excluded tobacco and gambling and all that sort of stuff on this side. But on this side, it's also added in companies that are focused on solar projects or wind farms or social
female CEOs, I see as well, is another one.
Yeah. So those types of things, and you end up with quote unquote an ethical portfolio. But I couldn't agree more with you that when I did a look into this many years ago, and Party Pooper, I looked into this many years ago because we have a free ethical investing course on Rask Education, so you can go and check that out, totally free. And it'll tell you how to build an ethical portfolio, or at least how to ask the right questions when you meet with your financial advisor, so you're talking the same language. And what I realized is that everyone's view of ethics is different. Everyone's view of sustainability, to an extent, is different. There are some carbon measuring rules and these types of things, which do have a lot of weight. But, I think if you're going to find it pretty tough to find something that exactly matches what you want, unless you're going to go individual stocks, which is a load of work. So, yes, you can build a portfolio. Yes, you'll pay a little bit more in fees. Yes, your portfolio will zig when the rest zag, as Alex said before. It will go up when others go down because you are excluding things and you are adding things in. But I think it's realistic. And I think if you believe in your values, then go for it. Get as close as you can to it. I think about 82% of the Rask community, when we did a survey many years ago, said, it doesn't matter if it's perfect, just being close enough or having some that are in line with my ethical values helps. So good on you. And I know it's something you deal with every day with ever as well clients. Right?
Yeah, that's what you said, that DZZF. We use that from time to time as well, because that is a very good, I think, out of the box. And probably if I could add one more point, the ethical funds as well, just bear in mind that you will typically pay a premium for that as well. And sometimes that premium can be quite high. So just keep that in mind. Some of them is just like, you almost ironically question the ethics of the fund in terms of what they're charging. I joke with clients sometimes, but the DZZF from Beta Shares is a very good out of the box option and very competitive on fees as well.
I should actually, full disclosure, just remember this. Beta Shares is a long-term sponsor of the Australian Finance Podcast, just so everyone's aware. Full disclosure, I know people like that, so that's there.
But they don't sponsor me, so
they do not sponsor him. They're not allowed to. So
no.
He's got a big shield around him. I should also say that one company that did lead the way in this is Australian Ethical, and we actually did a series with Australian Ethical about 3 years ago, a 3-part series on our Investors podcast. And we interviewed the head of ethics at the time and then 2 of the investors in the team in separate episodes. And that was really interesting because at the time, they're obviously kind of like leading the way and they have their ethical charter, and you can go onto their website and check what investments they have. And they had Facebook in their portfolio, and they were receiving a lot of controversy about, hashtag delete Facebook and that sort of stuff. So sometimes you won't agree, and maybe that's just something you've got to stomach, is what I'll end with. Superannuation, let's move to that as a topic. Space Tractor writes in and says, I thought this was going to be a tractor joke, and I thought I could get around this, but it's not. Could you please explain the contractor BPay super thingy you talk about? Good question. So this one, just for your context, Alex, is I encourage people to add extra to their super if they can through BPay. How do you do it?
Yeah, so what then I'm assuming contractor is asking here is effectively how they make a personal contribution to super. So there's two types of contributions you can make from that as well. There's a concessional contribution, which is one that you'll effectively get a tax deduction for in your own name, and then your super fund will pay 15% tax on that money put in there. However, there is a tax saving because 15% is typically lower than most people's marginal tax rate in this country. Or it's potentially a non-concessional contribution, which is effectively an after-tax contribution. So you've paid the tax, from your employer's taken out that and then given you, your leftover pay, and then you've put that into super, and there's no tax to pay on the super fund side with a contribution like that because you've already paid the tax before. Mm-hmm. In terms of do we want to discuss practically sort of how they look at doing this?
Sure.
So normally you would just go to, your super fund's website as an example, and they should normally have the details on there. But it's effectively just normally through BPay or a bank account. So your super fund will have its own bank account within there. Often your member number is the reference. Make sure if you are doing a personal concessional contribution, so the one that you claim the tax deduction for, you also need to lodge what's called a notice of intent with that. So effectively, that's it's like a 2-pager. If you just Google notice of intent, ATO, it will come up straight away. And basically on there, you put in how much you're doing as the personal contribution. So let's just say 10 grand, and how much you intend to claim as a personal contribution, 10 grand. That goes to your super fund as well. And they'll effectively then apply that correctly on their end, which means that when you go to lodge your tax return for that year, you put that in as a tax deduction, and that matches up with the ATO's record. Because if you don't do that, most super funds assume it is a non-concessional contribution, which, for the sake of the majority of people probably listening today, you're not going to want to do that one. It's going to be the one that you want to claim the tax deduction for.
Okay, so let's say podcast host Owen Rask has just received $5,000 from selling his old motorbike that just happens to be sitting around the yard. I don't have one of these, but if I did, that would be great. And I probably would do this. So I've sold it for $5,000 on Facebook Marketplace, right? Now I've got the cash sitting in my bank account. I think I could probably do something with this, or I could just top up my super. So I then go into Australian Super, Host Plus, insert name of super fund, and I get my BPay details. Got a reference number there. It's my member number. Bang, it's done. It's in there. Now I want to claim a tax deduction because I'm pretty savvy, and I think, you know what, that's $5,000 off my, income tax and accessible return, whatever. So then I would fill out one of these notice of intent to claim forms, right? And I'd send that to the super fund.
Yes, that's correct. And a lot of the time on the super fund website, they'll have that form as well. They accept either their own version or the ATO version, which you can simply Google. But yes, you must send that. So when we do it for clients, or when I do it myself, I just send it at the exact same time. So do the BPay and then email Aussie Super at inquiries.com or whatever it is. Here you go. Make sure it's lodged. And then particularly with anything, right, you should just make sure a week later or so that it has been received and they have correctly lodged that, because we have had an incident once or twice in the past with the bigger funds where stuff seems to go missing. So we just need to make sure that that's been done, because like I said, when you then lodge your tax return, you put that in there, the ATO basically lines those two things up in the background. And if they don't match, then they go, sorry, you don't get the tax deduction. And also you can't get your money back from super typically either. So that's also stuck in there. So sometimes I lose.
Yeah, that's a good one. So quickly on this, the rules were made a lot different quite a few years ago, which allows not just contractors to do this, but anyone can do this, effectively anyone. There's some rules. So say Owen, the podcast host, does have $5,000 and I am employed. I can also do it, but there are some rules that people should be aware of, Alex, around the limits.
Yes. So effectively, the current limit you can do is $27,500 per year. So say, Owen, the employee, has 20 grand that goes in from his employer. Effectively, his remaining cap for that financial year would be $7,500, of which the 5 grand from the motorbike sale obviously comes onto that. So we're fine there. The other thing where it can get a little bit more complex is what they've brought in the 18-19 tax year from then onwards is what's called a catch-up personal concessional contribution as well, a bit of a mouthful to say, which effectively says every year that you haven't used that full cap, so maybe you weren't aware that you could do this, Owen, over that period of time, so that 7.5 grand has sort of been left on the table every time. It's not lost. It's a rolling 5 year. So this is the last year of the first year that you can use from when it's in, if that makes sense.
Yep.
And, where this potentially can be used or deployed, the idea is to say you're older and you've had kids and, you haven't had a lot of spare money and now you do, you can now potentially add extra super, or you might have sold a share parcel or an investment property and you've got a large capital gain on that. This can be quite a good way to get money into extra super and reduce your taxable income. So you save a bit of tax in that sort of way. So it's a really cool strategy. As cool as super can be, I guess.
No, but it is.
To deploy, and it's available to anybody. It's definitely something that I think not enough people know about, and it can be really powerful.
So contractors who want to contribute to cover your insurance or whatever you might be doing inside super, people towards retirement age, this is something that you should absolutely positively know about. If this is the only thing you take away from this episode, get in touch with Everest Wealth or just go and Google concessional super contributions and how they work. It's also going up to $30,000 per year as of 1 July 2024 for people's benefit. We've got 2 questions here on business. Shelia, I think it is. I apologize for the pronunciation. You mentioned how you benefited from a coach when starting your business. I'm totally alone in my business and feel like I'm going around in circles most of the time. Can you recommend a business coach? I'm on a low enough budget as I'm just starting out, but any recommendations would be mighty. Thanks. Maybe I'll generalize this for everyone, but Shelia, we do have a Australian business podcast that is suitable because it's free. So you can just go and listen to that and you can hear more from the coaches and people that appear on that show. I'm curious for you, Alex, when you started your business, did you ever have something like this? Did you ever see a coach? How did you approach this?
Yes, I've never done the coaching thing per se. It's definitely something that I'm potentially considering going forward. However, in saying that, one thing that myself and my business partner did establish straight away was what we called a board of advice, which is a bit of a fancy term, but effectively we had about 4 people, in the industry at various different ages, various different skill sets and experience and stuff like that, that very kindly sort of volunteered their time once a quarter to catch up with us for a couple of hours for us to basically, bounce ideas off and then to give us direction. And we got a lot of value out of that in the first couple of years. We only catch up probably 3 times a year, twice a year. It's sort of less frequent per se, but that was really, really great at the start. Other things I think you can do, like if you're on a low budget and stuff like that, like YouTube's really good. Certain books and stuff like that. My advice there would be sometimes you hear people like they'll just go and read like 50 books and they're obviously all going to be different, but similar to a degree. Like the underlying theme generally should be pretty similar. So a couple would be fine. Because I think you're just going to find yourself jumping between too many things. So with this board of advice, for example, like the great thing about it is it was frequent enough that it was good and kept us on track, but it wasn't so frequent that it just became like, somewhat overwhelming of like, oh, we've got 15 things to do. Like we're just never going to have time to do all those. So we would just focus so generally out of those meetings, there'd be sort of action items and generally it would sort of be capped at sort of 3 to 5 max. And then when we met up next time, it was, you make sure you've ticked these off, which again was really good, holding us accountable thinking longer term. That's probably like, again, you can probably speak more to this because I think you've worked with a coach before. Is that right? Yeah. So like, the benefits of a coach, in any sort of, whether it's personal training or football coach or whatever, business, stuff like that, they can, can be a bit more objective. They can help you think a little bit more longer term. And then you've obviously got that, that accountability piece as well. But yeah, as a starting point, like, other people in the industry you can reach out to, before you go and commit to, say a specific business coach, which may be too expensive in this case. Board of advice. Yeah. And I ripped it off from somewhere, I think from a book, from memory. Yeah. So, and we started it right from the start, and it really, particularly that first 12 months, it was really good. Like it really did, keep us aligned, threw around a couple of ideas, and, it was very, very invaluable. And, we just normally would pay for lunch.
Yeah, that's great. I love that idea. That's what I did in the early days. It's just paid for everyone's lunch or a coffee. I just meet with anyone. And you'll be surprised if you're interested in going into business, you'll be surprised how much other business owners want to help you, because they genuinely know how hard it is. Like they really understand and appreciate how difficult it can be, and probably just wish that they had someone to help them. So they'll be probably, most of them, not maybe not all of them, but most of them would be chuffed just to sit down with you and talk about it. Obviously, Elon Musk is a bit busy, so maybe choose your targets wisely. But I started seeing a coach recently. She was more of a life coach, but just happened to help me with business. And I think a lot of the times what happens is business owners are kind of like, they've just got their head in the sand and they're just like doing and digging and just going through the motions of working in their business. They don't have enough time to pop their head up and see what's actually happening, like bigger picture. But they think about it, but they don't actually pause and get a moment of clarity. And I think that's where a coach can really help someone, or even just a trusted advisor, as you said, like having that quarterly meeting. One thing you can do is you can also get your friends and your family who maybe are on side with you doing your business, and you just send them a monthly update. So you send them an email, you write a monthly letter, a quarterly letter, and you just tell them what you're doing and what you're working on. You'd be surprised how much of them buy into it and support you and advocate for you. I don't want to push what we do too much, but I do have a business coaching business as well. And more people can learn about that on the Australian Business Podcast. So I work directly with business owners, but you can go and check that out. Noah did ask one final question on business, and I want to just bring this up. And the reason why we wanted to include these questions today is because starting your own business is very common in Australia, about 2.6 million businesses in Australia. Right. And I truly believe it's probably the best way to grow wealth, but it is probably one of the highest risk ways to do it. So sometimes it's all or nothing for some business owners, and I get that. So this one is about, I wanted to turn this into a different type of question here, Alex, because we have a free course on starting a business, but this one was interesting. I run a small business, and I want to learn more about investing and optimizing my tax obligations. Now, this is something that's really interesting because I imagine you deal with a lot of business owners in your job, but a lot of people who run a business or are sole traders or contractors or freelancers, they often don't know who to turn to for getting advice on how to structure their business or their work with their personal life. Can people like that come to you? Like you as a financial advisor who sees that type of thing, can they come to you and talk to you about that?
Yeah, I'm 100%. Like a lot of people don't realize that a financial advisor is a registered tax advisor. So effectively, we also, we carry a lot of certifications, and that's just another one that we have to add to our list and pay for every year. So basically what this means is, anything to do with tax, we're allowed to speak about. The only thing a financial advisor can't do is lodge a tax return for you. In saying that, obviously there will be some overlap between what we do and what an accountant can obviously advise on as well. I guess the technical difference in terms of what we can do versus an accountant per se is an accountant can talk about all the tax structures and how they work and stuff like that, whereas they can't technically give you the financial advice on which one you should potentially go for though. Whereas we can speak to that, right? Because we are licensed to speak about financial advice. And it is something that I talk about quite often to our small business owners, particularly like, if you've started out and been going for a couple of years and it's starting to go quite well, and maybe just set up as a sole trader, there can be some benefits from potentially converting to a company and having an underlying trust structure. Yeah, you may have beneficiaries you can just distribute to. There's a whole, it can become very complex. And, and we talk to that in terms of the upfront cost to obviously set that up, the ongoing cost that now you may have to pay, and whether that's going to sort of offset the tax optimization, for lack of a better word. But yeah, it is really important, and you're potentially leaving a lot of money on the table if you don't have that discussion either with your accountant or your financial advisor.
I got some friends that are tradies and work, or designers, and they work sole trader. They just get an ABN off the internet, and then they start billing, sending their own invoices off. And all of a sudden, some of them get to like $100,000 of income, and then 150 and 200,000. And they feel like they're so far down this road that they can't switch. And I can tell you can switch, and a good financial advisor can help you with that, or a good accountant will help you set up those structures. And if you do plan on taking it seriously, because, hey, it is your business, there are so many wonderful things that are available to you. Sometimes it does help to get a second set of eyes on that. So you can have like your advisor, your financial advisor, and your accountant to get separate independent opinions, because there may be different strategies that are available. But if you do run a business, good luck to you. Check out our free business course. Get in touch with an expert to help you set that up.
Definitely. And if I can add one last thing, it's not only the tax optimization, it's potentially the protection point of view as well.
Absolutely.
So back to your trading mates, home. So having it in a company can provide more protection than having it in your own name per se, which, like you said, hypothetically means the family home isn't up for grabs necessarily if something goes wrong.
Yeah, so important. We structured our affairs such that our property is separate to our business, and it's so important. And all the businesses are separate as well. So it's two good questions there on business. Check out our free course, check out the free podcast, get in touch with your advisor. The next two questions are more property related, but these are very, very topical for all of us. So we'll finish with these two, and then I've got one final question for you, mate. So the question comes from Dollar Each Way. Would love some general comments on purchasing an investment property to move into in the future, maybe in 2 or 3 years. We are young and flexible. I'm assuming they're meaning in terms of their lifestyle. Planning to travel and rent vest with capital ready to deploy. So they're happy to rent vest, but they're planning to travel. Thinking of an investment property. Thoughts on this?
Yeah, I love it. Like, I quite like it. Like, this is, it's funny. I've had a few clients recently, not specific to this, but they were more talking about like, we want to buy, in this area in 3 years' time, or 4 years' time, or something like that. And then when we've gone through the cash flows and their borrowing capacity and looked at their numbers and everything like that, it's more just like, why don't you just buy it now? Sort of thing. Yeah. A few times I've been like, oh, you didn't know we could, or et cetera, et cetera. So yeah, I mean, I don't mind this at all. You're getting that money into the market, so it's got an extra 2 to 3 years to compound. With investing, as you would know, being the guru you are, generally the earlier you start, almost always the better it's going to be, right? Like, you can't buy time back. I think, with this, obviously, you just need to do your own cash flows, and also be careful to a degree between investment and lifestyle as well. So yeah. So again, this isn't necessarily this situation, but a similar thing we hear from time to time is, look, we're going to buy that place down south or up north because we might live there at some point in time, or like maybe my daughter could move into it at some point in time or something, or we can holiday there every now and then or something like that. Like, that's starting to skew away from investment, right, to more of lifestyle. So, which is fine, but it's just sort of calling it is what it is, sort of thing. So like, just then maybe if you're going for just a pure investment lens, it's like, don't buy up north. Like, down south's way better value. So if we're talking about making money here, let's go down south. But I said, I guess I don't know too much more I can sort of add to that. But like I said, provided your cash flows are good and you've done your due diligence on that, and that is ultimately where you want to be, because obviously you're burning some borrowing capacity. Property has large transaction costs. Obviously you can sell it, but so it's a lot of money to get in. I don't think there's too much issue with that whatsoever.
Yeah, rent vesting. If you're planning to move into it, it sounds like it's rent vesting just for a little while. Seems like a pretty good idea. Just generally speaking, like, if you can, a lot of people aren't in the fortunate situation of being able to say, do I or don't I? They just they're in the wish I could camp. This is really interesting. And I think yeah, why not? If that's what you want to do, I'd say that it sounds like they've got their goals mapped out. They want to travel, they want to buy a property. It's sometimes for a lot of folks, it is a bit of give and take. Like you have to take one from something and not do something else, or do something else. So like maybe they can't travel as much if they've got a house. So just knowing those numbers, sitting down with your advisor or just doing it yourself is a really good way to think about that. I think rent vesting as a whole is quite interesting because a lot of people can't afford to buy in the place where they want to when they're younger and they really value that lifestyle. And there are pros and cons to that. But it, like you said, you're putting your money to work. And if that's the way you do it, that's the way you do it. So good on you. The final question comes from Breeze, which is listening to the recycling good debt through leveraging your equity in your home. I think that was the episode that they were listening to. My understanding is once you use this equity, you'll have to pay interest on it. So the investment you make using that equity will have to make more than the interest you'll pay on it. Is this correct or am I missing something? So Breeze is referring to, Alex, basically say someone does have a property, they were drawn $100,000 and they plan to do something with that. Either they're going to invest in another property or something like this, or maybe they invest in shares or something like this. The rest of it is like, I've got to pay interest on that extra $100,000. So I'm assuming my investment has to do better than that.
So yeah, you definitely have to do, you definitely have to pay interest on it. Your investment may not necessarily do better than it. That's not a guarantee, unfortunately. But yeah, this person, sorry, Breeze, I'm assuming it's a lady. Yeah, effectively, yeah, you borrow that equity or you take that equity out as a loan, you go and invest that. And then, yeah, effectively you will have to pay interest on that. But the interest is tax deductible as well. So let's remember that. So you are effectively getting a discount at your marginal tax rate on that interest expense. So the more you earn, again, we're in a progressive tax system and there's effectively levels as you go. So the higher level you are, the more of a discount you get. And as well, historically speaking, investment returns traditionally have always outperformed over the long term, effectively that interest rate that you would be paying as well. So interest rates are obviously a bit higher at this point in time. So again, you've got to run your own numbers and take these things into consideration. But historically speaking, it's, for the long term, so 10 years plus, it's always been better to sort of invest that money than not.
Yep. And that's a good point. And it doesn't suit everyone's risk profile either. This is typically a slightly riskier thing because you are taking money that is in your home loan and you're turning it into debt, or in your property. So you're turning that into more debt and then you're investing it, which isn't always sitting the most comfortable with everyone's stomach. So keep that in mind. I talked about it on that podcast and why I'm doing it for various reasons. But obviously, I'm very in tune with the way investing works and that nothing is guaranteed and these types of things. So it is a horses for courses, so to speak, in this instance. And there are certain things you need to know about the tax deductibility, how you keep that money separate. A lot of people do redraw from their home and just keep it in an offset account until they're ready to do something with it, or they prefer that flexibility. And I think at the moment, Alex, maybe just get a quick pulse check before we move to my final question for you, is I'd assume a lot of your clients are kind of happy just to keep money in an offset account because interest rates are high. They're saying, well, I'm paying 6.5% on my mortgage. So by keeping that money in my offset account, I'm effectively saving on that 6.5%. Is that what you're seeing a lot of, or am I way off?
Yeah, no, 100%. And it's definitely having that. I feel like I've said it a lot today, so I apologize to whoever is listening. Yeah, so we are seeing that, and it is having that trade-off discussion, right? Because it's not only necessarily saving 6%, it's saving 6% effectively before tax. So if you factored in your tax rate, it's more probably like 7.5%, 8%, right? Because anything we earn money on, so if we earn 6%, we would have to pay tax on that. So maybe it's a 4.5% return sort of after tax. So you're sort of getting that back the other way too. So yeah, I think, as you sort of said before, it comes down to very much horses for courses, what your own situation is. There's obviously a lot of admin things you need to be careful of. You need to understand how to keep the loan separate, all these sorts of things. Make sure you've got an emergency fund in place. It is obviously a more risky strategy. It's definitely a strategy that you have to commit to. It's not generally something that you can just do for a year and then take the money back. Obviously, you can from a liquidity perspective. However, there is obviously risk with that. So it's definitely a longer term strategy and something that needs to be, thought out properly before you go and commit to anything. And you wouldn't really do it with small amounts either. Like I've seen that from time to time. People are like, I'm just going to take $5,000 and do it. Like for all the rigmarole, this is me just personally speaking, I probably wouldn't be doing it for less than sort of $100,000 kind of at a time, just because of sort of the effort involved as well.
Yeah, you got to get your property revalued. You got to speak to the bank. You got to speak to your mortgage broker. It just goes on, and then you got to set it up and speak to your accountant. And yeah, it's a lot involved. So we've covered a lot today. We've covered property, business, super question on whether you're a contractor or not. We spoke about getting a car loan, HEX debt. Covered a lot today, mate. It's pretty wide ranging. My final question is. The one I always ask you, so maybe just 1 second before I get to that. If people want to reach out to you, they can at Everest Wealth. There's also a link in the show notes that says financial planning. Alex and his team specialize in people from, say, 20, maybe even a little bit younger, 20, 50. You're in that range. You're the target market for Alex and Everest Wealth. So reach out to the team, have a call with them, and just discover what they can do for you. There's a link in your podcast player. Final question, which is we do cover a lot of ground in these episodes. I would love to know what's one thing anyone listening to this or watching this on YouTube right now, which is where so many people engage with Rask these days, if they could do just one thing, or if you could get them to do one thing right now, they're about to hit pause or end and close their browser, what would you get them to do?
Well, I had a good think about this before we sort of started the episode, and it's something that even I struggle with from time to time as well. Is if you are thinking of, say, making that investment or doing something with your super or something with your insurance or something else, even in your own personal life that you've been weighing up for a little while, and you've been doing some research on, you've done a bit of due diligence, but you're still kind of on the fence to a degree. Yeah, I guess I'm just saying just commit to it, because I can't remember what the term was, but I was listening to another podcast the other day, and it was almost like, that there's obviously that the trade-off of not doing something actually costs you so much more in the long run. Whereas committing to or making that decision and pressing go or whatever it is on that sort of decision, that whilst it may not be completely sort of figured out, 9 times out of 10, it's so much better doing that than doing nothing.
I love that. Yeah. Kate often says that, you get confidence by doing, because that's what a lot of the studies suggest. I was listening to Poor Charlie's Almanac again on Audible this weekend, and there's a saying, I can't remember who originally had the saying hundreds of years ago, but it basically says something like, the man who needs a tool for his machine but hasn't bought it yet is already paying for it. And if you know that there's something that you need to do but you haven't done it, it's probably costing you and you don't even realize. So go out there and give it a crack. Start small, do it often, test, get a feel for it. You'll be okay. And we'll be back next week, so we can answer questions and do all these types of things. You've got a community here that can help. So we're here to support you. Alex and the team at Everest are also there too. So never fear. Mate, great way to end the show. Really appreciate your time.
No worries, mate. It was good fun.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.